Tariffs triggered trade wars, tanked the global trade, wrecked the businesses, put people out of work, and sent inflation through the roof. So, tariffs are bad. Really bad, right? Not so fast. Welcome back to Money Talks US, China, and Beyond. I'm Chris Lee. On February 1, President Trump decided to shake things up by waving his tariff stick, announcing a hefty 25% tariff on goods from Canada and Mexico, with an additional 10% slapped on Chinese imports. The stock market, it went on a one-day wild roller coaster ride on February 3. So with all these actions, before we dive into potential investment strategy that we talked about in our last episode, let's take a moment for tariff talk. So what's a tariff? Imagine tariff as the cover charge for the global trade club. When a country imposes a tariff, it's like saying, you want your gadgets in our market? You've got to pay to play. It's a tax on imports or exports, plain and simple. So is the tariff good or bad? Why is Trump waving the tariff stick? Why the tariff beef with China? Join me as we explore this complex beast and see where the road might lead for our economy, our jobs, our wallets, and how to tariff-proof our investments. So we're going to start with a lesson from history back in the Great Depression. In the twilight of the Roaring '20s, President Herbert Hoover promised to wrap America in a protective cloak against the world's economic storms. His vision? A self-sufficient nation where the plow and the factory stood unchallenged by foreign competition. As the stock market crashed in 1929, everybody knows, the Smoot-Hawley Tariff Act began its legislative odyssey. In the House, there was a Frankenstein monster, each representative stitching in tariffs on goods from pig iron to prunes. It passed like a battle cry, 264 to 147. But the Senate was a battlefield of interests as well, where Reed Smoot and Willis Hawley, with the skill of seasoned generals, navigating a storm of amendments, each senator fighting for their local interests, local industry's interests. Yet, as the bill neared its climax, over 1,000 economists, including Irving Fisher, raised a dire warning, foretelling economic doom, trade wars, and isolation. Their voice were but whispers against the roar for protectionism. In the Senator's 10th chamber, the final vote was drama incarnate, a nail-biting 44 to 42 votes. President Hoover, facing this economic Pandora's box, signed it into law on June 17, 1930, sealing America's fate. The aftermath was swift and harsh. The stock market recoiled, and the trading partners like Britain and Canada unleashed their own tariffs, crippling American exports. Global trade plummeted. In Pittsburgh, steel mills fell silent. Unemployment soared from 12% to over 40%. In Nebraska, Farmer John watched his wheat exports vanish, his fields turning to dust. In New York, families like the Martins struggled with soaring prices for sugar and coffee, while in Detroit, the Smiths joined endless bread lines, their dreams shattered. So back then, tariffs triggered trade wars, right? Tanked the global trade, wrecked the businesses, put people out of work, and sent inflation through the roof. Since then, many economists always waved red flag, saying that tariffs snuff out demand, hampers wealth creation, and triggers inflation to a point. They won't even use tariffs in their dating profiles, fearing it's going to just raise the price of love. So tariffs are bad, really bad, right? Not so fast. So to get to the bottom of it, let's dive into the nitty-gritty of tariffs with a twist of cooking analogy. Thanks to the insights from Jim Rickards, an investor, lawyer, and a former advisor to the U.S. intelligence community. He views tariff not as a one-size-fits-all solution, but as ingredients that can either enhance or spoil the economic feast, depending on how they're used. Let's imagine the global economy like a bustling kitchen where countries are chefs with unique recipes. Here's the scoop: the economic recipe: consumption versus production. So if you're chewing down more than you are cooking, you're in the deficit territory, like the US today, always hungry for goods from China, Germany, and Japan. Conversely, if you're whipping up more than you can eat, you've got a surplus, exporting your culinary creations abroad. So the US used to be the master chef with a trade surplus for all those years, including 1920 and 30s. But post-1975, after Nixon's move away from the gold standard, the U.S. has been on this wild ride of trade deficits by outsourcing our cooking, manufacturing. In the meantime, we encouraged countries to hold on to our dollars like they are the coolest currency in the playground, which, let's be honest, they kind of are, and used in everything from trade to loans. Our trade deficits have gone wild with decades of spending and outsourcing, particularly since China joined the WTO in 2000, flooding the market with cheaper goods. This has left areas like the Rust Belt feeling they're missed out on the feast, with much of their manufacturing bases flushed down the drain. Can you imagine the shock when we learned the U.S. couldn't keep up with Russia in producing artillery munitions? Or during the pandemic years, realizing that critical medical equipment like ventilators were mostly made in China, not here. So why the tariff matters and may be a good tool now versus 1930? Back in the 30s, the U.S. was already producing enough, more than consumptions. The manufacturing was strong. So the scorched the earth, smooth Halley tariff was like adding salt to an already burned dish. Instead of protection, it amplified the pain, making the Great Depression even worse. But today, with the U.S. consuming more than it produces, and domestic manufacturing possibly at a low in decades, tariffs could be the secret sauce to boost local production, encouraging foreign companies to set up shop here, leading to jobs, investments, and tech leadership. But here's the twist: bringing manufacturing back home isn't without its challenges. We've been outsourcing for so long. We've lost some of our cooking skills, manufacturing expertise. Although people argue that automation may help. Plus, our energy infrastructure might not be up to the task. And the high healthcare costs on companies are like extra expenses that make cooking at home more expensive. Critiques also worry about potential trade wars adding to near-term uncertainties. And there's a stance of currency and interest rate. They're like the heat and the seasoning of your dishes too. A stronger dollar might soften the blow of tariffs in terms of inflation, but also reduces their effectiveness in boosting domestic production. And the dollar's strength is also influenced by interest rates or the expectation of the interest rates trend, making economic forecasting as complex as predicting a storm's path. Now today, obviously, Trump and his Treasury Secretary Scott Bessent apparently believe they can be the chefs mastering this tariff ingredients again. and see them not just as a way to rake in some cash, but as a revival strategy for American business, much like Alexander Hamilton did, particularly to shield key sectors from China. Tariffs are negotiation aces in trade and the foreign policy talks, like chess pieces to nudge countries toward fairer play or to get them to do certain things. Take the 25% tariff on Canada and Mexico. It's linked to pushing for tighter border controls against illegal immigration and the fentanyl smuggling. And then there's this new additional 10% tariff on all China's imports. Now, for China, the Chinese Communist Party, or CCP, this isn't just about dollars and cents or just the fentanyl anymore. The US is playing chess with a global strategy to counteract the CCP's big moves. Tariffs are part of the plan. So are Panama Canal and Greenland. Did you know Marco Rubio, the new Secretary of State, convinced Panama to hit pause on their Belt and Road deal with the CCP? That canal, once American, was handed back, but now with China's heavy investments, it's more like a spy hotspot than just a trade route. And the CCP isn't just sitting back. They responded with counter tariffs on U.S. goods from coal to liquid natural gas, machinery to vehicles. Plus, they've made a strategic move by controlling exports of 25 rare metals and adding Google and Apple for their unreliable entity list. But why all these fuss? It's because of CCP's state capitalism. Basically, they're throwing cash at industries, flooding the world with cheap steel, solar panels, and electric cars, which messes up the global markets. Remember the 2015 steel crisis? That was all CCP's overproduction. And they're not playing fair. With government subsidies, they undercut everyone, ignore environmental rules for cheaper goods, and let's not forget the tech theft scandals with companies like Huawei and the ZTE. Then there's this economic bullying, like with Australia over wine and coal. These are all part of their overtaking on a band strategy with no limits and at any cost, aiming to speed past the West. Now here's where it gets even more interesting. The CCP is all about boosting production than encouraging domestic consumptions. Many say it's not the smartest move economically for China now, given the economic conditions. But others whisper it's all about gearing up for something bigger, like maybe a war, as we just talked about in our earlier episodes. So will the CCP negotiate with Trump on these tariffs? They'll have to. They'll absolutely have to. How does this saga going to unfold? Oh, we're going to all watching with popcorn at the ready. So, bottom line, the Trump administration sees tariffs as the versatile tool, not just for economic gain, but also for strategic global positioning. It's about protecting our backyard, negotiating with authority, all while playing the long game in international relations. Tariffs are like spices in the global economic kitchen when used wisely. They can enhance the meal, promoting growth, jobs, and stability. But it all hinges on the right conditions, knowing when to add the spice, and not just how much. And the outcome can still be unpredictable, especially in the near term. Now, if you're thinking about investing to protect your portfolio against tariff, I would say steer clear of those big, globally dependent, tariff-sensitive U.S. stocks. They are already overvalued, pricey. Take Apple, for example. Where are they going to move manufacturing if China faces more tariffs? Shifting to India isn't a quick fix. And what if India gets hit too? That could jack up iPhone prices. And Apple's already at a 36 times earning ratio with no revenue growth lately. And Walmart? It's trading at nearly 40 times earnings. Everyone loves it, but it's got this tiny, rather thin profit margins. If tariffs come, they're going to have to either squeeze their suppliers, find new ones at a cost, or pass the price hike to us, the consumers. So what's the better deal? What's the better bet? Look at local undervalued stocks like Adobe, which is exploring AI to make its tools more accessible, although there's risk of open source competition. And then there's Itaú Unibanco in Brazil. It's got growth potential, but carries some local economic risks. And Chevron, the iconic oil company, solid dividends, relatively undervalued. Oil is always a wild ride. And lastly, let's not forget about gold, Bitcoin, treasury play, AI defense stocks. We're going to dive deeper into all of these in future episodes. So thanks for tuning in. If you like what you see here, make sure you subscribe, like, and share, and tell us what you think in the comment. Also, turn on that notification so you don't miss any episodes from our program. See you soon.